books, authors, teachers, mentors, courses, products. None of that is going to remove the impact that you yourself bring to this. The learning curve is going to be whatever it is for you, however long it is, because of who you are and what you wrestle with. And pretending that you don't have any of these problems that I talk about and other traders may refer to is nonsense, because there is no perfect student of the market that came in with no baggage or no mental barriers. Everybody has their own things. And some of them may not be a point of which where you overcome them. And it might not be feasible for you to do this. And then you would have to submit yourself to someone that does it really well, and you buy their signals or setups or their product. And in that case, I don't think that's wrong. I don't, if someone can prove that they have something that works, or they have a signal service that does well, and you can't do it yourself, I don't think there's any shame in that at all. There's no shame in that, because it's difficult, folks. You're the deciding factor in whether you're going to succeed or not. It's not the thing that you're using. It's you. It's you and what you are willing to do and what you're not willing to do. So in London, you're looking for false breakouts and runs above relative equal highs when you're bearish, or a single high that is inside of the previous day's range. Now, I know there's no chart here, but I want you to think about conceptually. Let's look at it like this. If you have note-taking instruments in front of you, this should be an easy thing for you to do. Let's just say, hypothetically, you draw a rectangle, leaving room for a rectangle to the right of it, okay? So you're going to draw a rectangle, and at the top of that rectangle, you're going to say 100 is the high, and the low is 20. So you have a previous range of 80 units. It could be pips, it could be points, it could be whatever. But we're going to say it's 80 units. Then you're going to see where you open up at 2 o'clock in the morning, New York local time. Wait a minute. What do you mean open up, ICT? Wait. Look. You just said, and I understand that the market starts trading at 6 o'clock. What are you talking about opening at 2 o'clock? Yeah, now we have a new opening range. 2 o'clock's opening price. What is that? The first opening price on the first 1 minute candlestick at 2 o'clock, New York local time. You want to note that. Now that's an important price point. From that price point, you want to see it be, if you're bearish, you want to see it be below the 20 level of the previous day's range, because that's what that rectangle would represent. And that's, for example, let's just say at 2 o'clock on the trading day that you're in right now, say it's 18 in reference to the previous day's range. So now you're below the low of yesterday's daily range. So from 6 o'clock all the way now to 2 o'clock in the morning, the market has done whatever it's done. If those highs, that relatively equal high or a single high in the previous range between 20 and 80, if there's a single high or relative equal highs in that lower 1/3 or quarter point of that previous rectangle that you're drawing out, that represents the previous day's trading, you're anticipating at 2 o'clock in the morning on the trading day that you're watching price at right now, you want to see a Judas swing shoot up. You're going to anticipate that. You're not going to react to it. You're waiting for it. You want to see that very thing happen. Now, as an ultra short-term scalper, you can buy that, but you have to be very nimble, because it can go up there and turn on a dime quickly, because London is a false breakout characteristic time period. When it runs up there, why are we anticipating a run back into the previous day's range, but only the lower quarter or 1/3% of the range? Because we don't think that the previous day's high is going to be taken out. And we don't think that half of the previous day's range is going to be a factor at all. The best shorts are going to occur in the lower half of the previous day's range when bearish. What did you just say? The best shorts will occur in the lower 50% of the previous day's range. Where do they form? Above old highs, inside of that range. Where you look for it, just like the algorithm will look for it, it's going to look into 15-minute high or highs, or 5-minute high or highs inside that range. So if you're in a 5 or 15-minute chart, it can't hide from you. It's right there. And you're going to anticipate the market running up there. And when it does, you paper trade it, you tape read it, you do not live trade it. You have to condition yourself to do this. And it takes weeks and months to do it. Not, oh, a couple weeks I've been doing it. I know what I'm doing. No, you don't. No, you don't. You do not. It takes time to desensitize yourself to the fear that London can create because it's very, very volatile. It can run up there and rip right lower. And really, if you know what you're doing, you can miss it or second guess it and totally do harm to yourself. So in London, you're looking for turtle soup scenarios, okay? And continuation on the basis of the higher time frame order flow. High a day, low a day is what's formed in the London session. Most of the time, not all the time, most of the time. In New York session, this is going to be for Forex traders, the New York Open Kill Zone, which is 7 o'clock to 10 o'clock New York local time. If you are an index trader, you can use that same time window as well. You use that time window before the opening at 9:30, like between, like, say, 7 o'clock in the morning New York local time to 8:30. You can trade that time window when there is a really big high impact news driver for that day. For instance, like FOMC. Okay, say FOMC, or let's say, we'll stick to that. FOMC is probably like the best case explanation for why you would want to trade before the 8:30 hour, because generally what will happen is you'll get these really nice little price runs that are, and I've executed and showed you this throughout the year, and last year I was doing it too. And usually it's the time or examples where you see people saying, but didn't you say we have to wait for this and we have to wait for 10 o'clock? Folks, I'm giving you different models. That way you are allowing yourself to pick up on what you want to do. I can trade all of them, but I can't make you be able to trade all of them. I mean, over time you can if you put the time into it, but you have to find your own special time of the day in the asset class that you trade. And that's what I'm covering here. I'm helping you refine your level of focus so you can pinpoint what your model is going to operate in terms of time. So that way you're not doing more than that's required. You're not diluting your attention, and you're also controlling fear of missing out. Because if you're operating in a business model or trading model that allows you to only operate in this 2 or 3 window time period of every individual day, you turn the charts off and you walk away and you exercise discipline. Over time, you won't care what the market has done over here or this time of day or who made this, who made that. You're trying to get better at this. You can't improve by worrying about how much other people, me or anyone else, is making or losing, or how often we get it right or wrong. You can't do anything to make yourself better by doing that. So why are you worrying about it? If you're pocket watching me or anyone else, or if you're entertaining other people that do that, you are wasting your time. You're wasting time to groom yourself into the analyst that's necessary for that profitable trader to work with, because the trader's not going to be doing anything except for what the analyst says is good to go. And you can't do all these trading sessions in the beginning. You can't. Now, you can study and backtest all of them. That's not trading. That's a good use of your time. But you can't go in as a new trader trying to do all these things simply because you've heard about it or have talked about it. So therefore you're going to go in there and you're going to figure it out. You don't figure it out that way. You study, you backtest, and you figure out where it fits for your life. That's the only figuring out you're doing. Does your life allow for you to trade in the London hours? Most people can't. If you can find time to get in there and trade in the pre-market hours before 9:30 and look for a setup between 7 o'clock and 8:30. Okay, there you go. You can find a setup that will probably yield you an opportunity, and then you're done. Where everybody else is waiting for the 9:30 opening at equities, opening bell in New York, to find their trade. Or if they trade the silver bullet model, they have to wait till 10 o'clock. And this is funny when I see people, I'm taking trades and I'm doing something before 10 o'clock. And they're like, wait a minute, didn't you say we have to wait? Who did I say had to wait? You. I didn't say we. I said you wait until 10 o'clock. I'm not saying we wait till 10 o'clock. I said you. I'm tweeting you wait till 10 o'clock. That's not me saying I'm not going to do anything else or anything in addition to, because I have a varying spectrum of experience in terms of students. Like I have long-term students that have been here. I have charter members that are in my mentorship. I have students that have been with me longer before I did mentorship and never joined my mentorship. And their level of experience with me is much more vast than yours. And then I have the neophyte that just come to me today in this discussion today. First time they never heard me before and they're listening to it. It probably doesn't make much sense to them, but their experience with me is brand new. So when I counsel you to do specific things or not to do certain things, that doesn't mean I'm limited to that, but to keep the growth of the entire community going, not just being a one trick pony, which you can clearly see I have a whole lot of ponies in my fold. I got all kinds of models. Okay. And my models work because of the element I'm teaching here, time. I'm looking for setups in the New York session. The characteristic for New York is a continuation of what? Whatever London did. When does that not occur? If the range expansion that occurred in London and then continues into New York and it trades to a higher time frame PD array, something that I would have been targeting anyway, which was the basis for the draw on the bias for the weekly chart and or daily chart. So in other words, if it gets in my higher time frame target, then what shifts in my analysis? Market reversal profile. Otherwise, I'm looking for New York session to continue in the direction of whatever that higher time frame draw is on the weekly and or daily chart. And I'm going to submit to that. And I'm going to look for the things that I teach you that the algorithm will show in price delivery, inefficiencies, runs on stops, the whole business. I'm looking for those factors to come in agreement with that. And if it doesn't materialize, or if it's wishy-washy, it could be done and explained both directions. That's low probability. It's not a trading environment I'm going to trade in. And then I watch, or I'll tell you, this is what we're looking at. We're watching it. So it gives you experience to see what it's like when it's not optimal, but still putting chart time in. You need to have that. And I have the other students that are coming here because their attention span is the size of a gnat and they want everything right now. It's already 3 weeks late. You just met me and you want to get right to the point of, hey, take a trade, or you don't know what you're talking about. Or you don't know what you're talking about because you're doing this and you're doing that and you're not entertaining me. This is not how I want to be taught. Then go somewhere else. I promise you, there's a lot of people out there that's going to teach you wonderful things to get into the marketplace. The results are not going to be what you would get in comparison here. You're not going to be in control of yourself. You're going to be constantly looking for a new high, not in equity, but in dopamine. And that's what social media traders and influencers present to you and provide you. I am not trying to do that. Now, when the market performs a specific way, then obviously I'll put a meme out there, a little funny little, tweet of some kind to anchor it emotionally to you, not to make it look like we're celebrating, ego or anything like that. It's to make you feel like this was worth you watching it. And if it causes you to smile or laugh or, think to yourself like, oh, no, ICT's a ham, it anchored it. And that's all I'm aiming for because it's meaningful because you didn't take a trade. So I have to give you that cookie, that yellow belt from a white belt to a yellow belt. That's that little progression for you as a student because you didn't take anything out of it money wise. You didn't lose any money, you didn't make any money, but I have to anchor it to something that you can recall or inspire you to journal it. Because until it makes its way into your journal, it's wasted time and attention. And I'm going to say that again. If you're watching or listening or look at my tweets and you do not journal the things I'm calling your attention to, you are absolutely wasting your time. You're not wasting my time. I know this stuff, but you're wasting your time. And that growth, that learning curve is being elongated and pushed further into the future by you not doing the simple thing of simply logging the experience. What does that mean, logging it? Framing it in your chart by time, When did that set up for them? In the times I'm talking about here. And we have a couple more I'm going to get to, but you look at it in the basis of time. And how does that move fit in the grand scheme of the last 3 trading days? Where we are in terms of what the weekly candle was likely to do, expand up, expand down. Where did it occur in the calendar event for that particular trading week? Did it occur on the heels of a medium or high impact news driver? In other words, you look at the economic calendar, if a medium impact or a high impact news event or report or something like that, was it on the heels? Does it occur after that market report hits the wires and people can see the data? Or was it in between a medium or high impact news day? All those factors mean something. And you have to find your own comfort in how you're going to trade. I don't say traders need to be afraid of medium or high impact news days. We want those days because there's going to be a lot of manipulation. And then if they're going to manipulate the market, that means they're going to punish one side of the marketplace. And we can see clearly what side's going to be punished. I do this every single week. Every time I sit down with you, I outline what I think is going to happen. And for the most part, it pans out. Not always, but most of the time it does. And it's all based on time-based principles. It's scheduled volume inflows, that these things occur because this is where all the orders are going to come in, or they're going to run for the pending orders that are existent in price action, and how you're going to engage that. And it may feel like a whirlwind of ideas that you're being confused by because I'm always introducing something, or I'm executing on a model or approach that maybe I haven't taught you yet. But I don't like sitting down anymore because I've been here doing it long enough that people know that I can do this. And students know that I can do this. Even the people that don't like me know I can do it. But they just want me to jump and dance around for them. Okay. And that's entertainment for them.